That this video is for educational purposes. This is not financial advice, but we all know why you guys are here. You guys are here to find good, credible trading content and information that can help improve your ability as a trader and to help put a little bit of extra money into your pocket. Okay. You don't have to go anywhere else. It'll do the hard work. We'll do the hard work for you. All you have to do is like and subscribe to videos. Okay. And we're going to keep coming out with this content for you guys. So all you have to do is just watch the video, then boom, head straight to the charts. Okay. So with that said, let us discuss what's happening with oil. So oil prices in the second week slips as emergency supplies release to ease supply fares. So what we have happening here is that oil prices were getting astronomically high to the point that it was raising global inflation. Okay, everybody's feeling it. Okay, everybody, every country, everybody around the world is feeling it. It's causing some riots in South America. It's causing nations like New Zealand and now Australia to start to go slink deeper into inflation. It's almost about to push the whole entire EU into recession. Okay. And America, we're definitely feeling it here too. Okay. So these high oil prices started getting carteled down due to the lot of the development in nations around the world that have oil reserves to release their oil reserves into circulation. Okay, so oil prices settled higher Friday, but slipped to another weekly defeat after countries agrees to release millions of barrels of their energy reserves, offsetting the rushing output into early April as sanctions bite. Okay, so basically, what you have to understand is that this shortage on oil is an artificial shortage. Okay, it's not caused by any type of natural events that's causing us not to be able to get oil up out the ground. This is not caused by any type of economic indicators in which the needs of oils are fluctuating between markets or industries or sectors. This is nothing like that. Basically, what caused the oil to be artificially supplied to decrease was America and NATO putting sanctions on Russian oil so they would not be able to sell it. Okay. Now you have to understand the three major producers of oil around the world is the Middle East, Russia, and Canada. And the way they calculate the oil to see what the supply is not based off of, okay, this is Canadian oil, this is Russian oil, this is Middle Eastern oil. It's all counted as one. Okay. So when there's an issue with one of these supplies from one of these nations, it automatically causes the overall supply. It affects the overall supply. So once NATO and the American government put sanctions against Russian oil, in which they would not, which nobody's basically allowed to buy it without getting deemed a harbor of terrorism or without getting deemed contributing to genocide, right? That nobody's touching Russian oil, which means that there's an artificial decrease in the supply of Russian oil around the world, which means there is a decrease in supply of oil around the world, which means the prices per barrel of oil goes up. And how they affects the everyday consumer is that gas prices start to go up tremendously. Okay, so oil prices were deflated by a blow this week after member nations of the International Energy Agency agreed to release 60 million barrels of oil over the next 6 months, easing fears of a supply shortage. This sizable release of oil from the emergency reserves, in tandem with the United States plan to release 180 million barrels of oil, would likely ease the supply situation on the oil markets noticeably. The easing fears of supply distribution at the least temporarily offsets the signs of failing production in Russia as sanctions appear to be having an impact on Russian crude demand. So basically, this is the article explaining that the due to the Russian sanctions, this is having effect on it, but they're trying to cartel this effect or offset this effect with releasing of emergency oil reserves. Okay. And also, there's another factor that's happening with this, and we're going to have to start paying close attention to this to see how it's going to start affecting the overall forex market in general. Is that oil demand from China has dropped by an estimated 1.2 to 3 million barrels daily as a result of lockdown. Okay. Now, this lockdown is coming from COVID-19 that is sprung up and started to affect the Chinese people and to affect China's country as a whole. So the Chinese government had put the entire country on lockdown, put the country in lockdown to try to curtail, infectious rates and to keep those rates down before it goes full blown into another global pandemic. Okay. So, how is this going to affect the overall Forex market? Okay, we will start to see a continuation in the decline in price in oil, but please, I have to stress this to you that this is a temporary fix. This is not a long term or intermediate fix. This is more of a short term fix because even though the article says that they're going to be doing this for 6 months, we don't know what can happen within 6 months that can change the minds of these governments that in which they will stop sending out supplies of oil. Okay, the supplies of oil are really reserved for when you need it for your military or like natural disasters or times of emergency, not times of geopolitics affecting oil supply. Okay, so this is like a temporary fix. So imagine you have a broken leg and they give you a band-aid instead of trying to put the broken leg back together. So this is what we're seeing here. So it's going to be a temporary fix in which we're going to see a price drop in the markets. But if we have any type of unrest in the Middle East, okay, if the war between Russia and Ukraine becomes a lot more aggressive, okay, if they start to become much more strenuous with the sanctions against Russia and Russian gas and Russian oil, in which they are threatening the other countries that are doing business with Russia to buy their natural gas and oil, we will start to see in a very upgraded take in price. Okay, you have to understand prior to this whole uh, Russian Ukrainian war incident, per barrel per oil price will usually trade between 50 to like $80, sometimes dropping below 50, sometimes creeping just a little bit above 80. Okay. And that was basically the price range. So now our new range is within the 90s to about the low 100s, almost like 110, 115. Okay. And that's extremely high prices. Okay. This is why all of a sudden last year, if you were in America, you seen on the East Coast, gas was on average like 260, 250. Now gas is 360. And you're praising and being thankful for that because it was once almost going 230 north of $4. Okay. Be prepared to pay more at the pump as soon as the summer months come, because the summer months come, travel demands become higher. So does certain product demands become higher, and you need oil and gas to ship these things about. So they're basing this supply of emergency being supply being sufficient for what is happening right now. But when we started to have those surges in oil needs, like we always do throughout the summer months, that supply is almost going to be like a drop of water going into a barrel. Okay. And then what is going to happen is they're going to have to make a decision. Do we keep putting out our emergency reserve oil to meet the increasing demand of oil going into the summer months? Or do we start to cartel that back? Because if we use all our emergency oil and then the emergency happens and we have no oil for this emergency, we're going to be in basically a loss situation either way. Okay. So if they stop sending out the emergency oil due to the high demand of oil, then you're going to see prices skyrocket. If they use up all the emergency oil to try to bring down prices now and an emergency happens, prices are going to skyrocket. Okay. And how this is going to go on the charts is basically we're going to see a drop in oil prices initially for the next several trading weeks. Okay. Most likely not dropping nowhere below 90 to about the high 80s. But then as the summer months start to come, we're going to start to see a resurgence in oil prices getting to above 100 and north of $100. Okay. So you can be prepared for that when you're looking at the charts. So for right now, for the next couple weeks, the short to intermediate time frame, you're going to be looking for shorts or sales. But for the long-term time frame, you're going to be looking for long-term positions of buy positions that's going to continue to go into the fall of this year. Okay. And if you're dealing stocks, this is when, as prices start to drop down, you're going to see a drop down in all oil stocks, all gas company stocks. And then that'll be a perfect time to buy just prior to the summertime. Because when the summer comes, you're going to start to see these stocks hit at all-time highs just because of what's going to be happening. Okay. Now, I hope this information will help it for you guys. Happy trading.